This chapter is on the new leasing standard. They've worked many, many years. I remember back when I was at your stage, they came out with, the FASB came out with Statement 13, which was voluminous. And we had to actually read the standard from, well, directly. It was not in the textbook, and it was very, very difficult to understand. And so this new standard fixes a lot of the problems. I think they've done a great job with this in terms of the financial representation of the liability, particularly by the lessee side of the transaction. And whereas before, even though you had a non-cancelable lease agreement that covered periods longer than a year, they weren't recorded as liabilities, and there wasn't an asset that was shown other than prepaid rent. So this new standard takes care of a lot of that problem. I will forewarn you, there's a huge amount to memorize in this chapter, a lot of rules. So we're going to go through this. It might seem dry, but I've got to get out of the way a lot of definitions and so forth, particularly when we get into the capital lease accounting. There are two types of leases in general. The first are the operating leases. We'll discuss those first. And then there are capital leases, which are treated as an acquisition transaction by both the lessee and the lessor. The lessor is the one who owns the asset, and the lessee, of course, is the one who transacts with the lessor to lease the asset for a period of time. And we're talking about non-cancelable contracts, and primarily those that are long-term. So if we start here in the notes, it does say that unlike short-term rental transactions, a lease is a long-term that is greater than 12 months contract transferring control of the right of a use asset. And we'll refer to that as an ROU asset from now on, from the lessor to the lessee. And economically, leases then transfer both the risks and the rewards of an asset, just as they would in an acquisition transaction, as when legal title actually transfers. So our first discussion is on the operating lease. This is a lease that does not meet the capitalization criteria, which we're going to cover in the next section. And under the new standard, the lessee is required to show the leased asset on the balance sheet, just as if they had purchased it, with a related liability equal to the present value of the determinable lease payments. Contingent lease payments are not considered. Often in these types of leases, say a retail store in a mall will rent space, and there'll be a fixed amount per month. But there might also be contingent rentals, which are a royalty that the lessee pays the lessor percentage, some percentage perhaps of their total revenue that they bring in from the store. And so in that way, the lessor gets to share in some of the rewards of the space, as more popular areas, more popular stores would have higher royalties that they have to pay. So those can't be considered in the lease payments because you don't know those in advance. They couldn't be known, and so therefore they're not. You can't find the present value of those. They're just going to be expensed as incurred by the lessee and treated as revenue by the lessor. The discount rate that's used to do the discounting is the implicit rate in the lease, if it's known. Now, the implicit rate, as we're going to talk about, is the rate that the lessor set the lease payments by. Certainly, if you own an asset and you want to lease it to some other party, you're going to require payments that are going to recover the value of that asset plus interest. And so the implicit interest rate is the rate that the lessor uses. If known by the lessee, then they're going to use that rate. Usually the contracts will state what the APR, or the annual percentage rate, is. But sometimes it's not known because the payments that the lessee has to make might include some other things, which we'll get into, other than just payments of the actual value of the asset itself. It might include, for example, maintenance if you're renting a copier, or in terms of cars, if you're renting a car, the lessee payments might include insurance that the owner of the car, the lessor, has to pay. And so those sorts of things are not a recovery of the actual value of the asset. They're incidental. And we'll get to that too. So if the lessee does know the implicit rate in the lease, that's what they're going to use. Otherwise, the lessee would have to use what we refer to as their incremental borrowing rate. That's just the rate that they would be able to finance the asset if they purchased it and the asset served as collateral for the loan. Lessor accounting for operating leases is completely unaffected by this new standard. It's all on the lessee side. And specifically, as far as the income statement and statement of cash flows go, the lease payments conceptually consist of both interest and depreciation expense. If you think about the payments on a lease, well, like I said earlier, you're recovering the value of the asset, so that portion over the life of the lease is depreciation, and then anything on top of that is interest. Under U.S. GAAP, we have a difference between U.S. GAAP and IFRS, but under U.S. GAAP, they made it easy. They just said lease expense is equal to the lease payment itself, and that's the amount that's going to be expensed as the time accrues over the term of the lease. And under the international financial reporting standards, the lease expense is different. It's going to equal the portion of the lease payment that represents interest on the liability, plus they require straight line depreciation or amortization of the asset itself. So I'll illustrate both of these. For the balance sheet on the lessee side, the undepreciated balance of the right of use asset is shown as an asset, as I said. So that's going to be depreciated just like any asset other than land, and the unamortized lease obligation is shown as a liability. Now, the FASB did make some exception for immaterial leases, such as cell phones. If a company rents cell phones for their employees, those are relatively small, and they can be, even if they cover periods over a year, immaterial items can be just treated as rental transactions. So for the lessee, they're going to debit prepaid rent and credit cash. They're not going to record an asset. They're not going to record a liability. It's just as you've learned previously in your classes about prepaid leases. Leases are always prepaid, so we'll get to that in terms of the discounting of it too. And for the lessor, they just debit cash when they receive the payment and credit unearned rent, and they treat it as revenue as the lease term goes by. So let's get into an example. Lessor company and lessee company sign a 3-year lease contract on September 1st. So we're going to have partial period amortization here, but it says that took place in X1 for an automobile, and it called for semi-annual rentals of $3,000. I'm making this easy. Rentals would be monthly, but let's just say that they're semi-annual, every 6 months. And the auto has a cost to the lessor of $36,000 and an expected life of 5 years. So we'll have zero residual on this. And although the implicit interest rate on the lease is unknown by the lessee, which really wouldn't be the case, but let's just say that's the case for illustration purposes, it has an incremental borrowing rate of 7%. So if they bought this car and it was secured in the loan agreement, they would face a 7% interest rate. So it says determine first off the present value of the lease for the lessee company. So we've got $3,000 as a semi-annual lease payment. We're going to use 7% for the discount rate. You have to have that because it's every 6 months. So it's an annuity. And since it's every 6 months, over 3 years, that's going to be 6 payments. So that would be an ordinary annuity, but leases are always prepaid. So the first payment occurs at September 1st, and that makes this an annuity due for present value purposes, which we've already learned you multiply by 1 plus the discount rate to convert it to an annuity due, which gives you a value of $16,545 as the discounted amount. So on the next page, it says prepare the following partial amortization schedule for the lessee company. So I have here, of course, on 9/1, the inception of the lease. there's a liability that is created for that amount we just computed of $16,545. There is no asset amortization as of yet, so I'll just put a 0 there. And also you notice I have the same date. There wouldn't be any interest, but there is that first cash payment that's made initially at the inception of the lease of $3,000. So it brings down the liability immediately, dollar for dollar, $13,545. Again, there's no amortization involved yet because no time has passed. So 6 months goes by on the amortization schedule, and as always, you're using, for the interest on that, you take the previous balance, $13,545, multiply it by 3.5%, and you get $474. Sorry about that. There's no low battery on this. So you get 474. I will plug in my machine just to make sure, but I'm pretty certain there's no problem with the battery. All right. So as all liabilities do, they grow by the interest. They come down by cash payments that are made. So the new liability, $13,545 plus $474 minus the $3,000 gives you $11,019. And now is when you would start amortizing that asset. Now I want to show US GAAP requirements for this first. And what they say is that the portion of the lease payment that is not interest is going to be the amortization of the asset. So to computationally get that amount, take $3,000 minus the $474 that's in that payment. The rest would be a reduction of the asset, $25.66. All right. So another 6 months goes by. Now interest is on that previous balance of $11.19. So what you get for interest is $386. You make a payment. New liability balance is $84.05. And now again, amortize the right of use asset. Take the payment minus the portion representing interest. And you get $26.14. New interest amount after 6 months, $294. Payment. New liability, $56.99. Asset amortization, $3,000 minus $294. $27.06. Now you notice that these amounts are growing, and that's because the interest is declining over time, as it would on a liability as this principal is being repaid. Another 6 months, $199 of interest, $3,000 is the payment. New liability balance, $28.99. Amortization, $3,000 minus $199 gives you $28.01. New interest on the previous liability here, $101. And this is the final payment. There are 6 of them now. So you bring your liability down to 0. Amortization, $3,000 minus $101 equals $28.99. Now it looks odd here, but what happens is another 6 months goes by because the payment was made at the beginning of that 6 month period, so they've got another 6 months use of the asset, but the liability is fully paid, so there is no interest. There is no cash payment more, and the liability doesn't change. It's zero. So the amortization, because you have it another 6 months, is $3,000. So that's basically how this works. Just notice that these amortization amounts are going down, and you could compute each one of those as the previous one. Each equals the prior, whoops, sorry about that. Sometimes working with a tablet, these things happen and I can't avoid it. So each equals the prior amount times 1.035. So you see they're growing at the interest rate. So it's a good way of doing depreciation because it actually results, and I don't know if I can adequately explain all this, but it results in a constant return on the asset for the lessor, or lessee, I should say, because they're using the asset for operations over time. And that's just a theoretical result that you can just stick away in the side of your mind. You don't need to know that for the exam. But yeah, I would like you to know that these things are growing at the 3.5% rate. So let's make some journal entries here. I've got both sides. It says prepare the lessees and lessors journal entries through 3.1 of X2. So on the lessee side, on 9.1 of X1, they're going to record an asset, and we'll refer to that as a right-of-use asset. And it's for the amount that we computed as the present value, $16,545. And they're going to put on the books a lease liability for the same amount. They also make a payment, which is a dollar-for-dollar reduction in that lease liability at time 0, $3,000, and they pay cash. Lessor, on the lessor side, they receive cash of $3,000, and their accounting is not affected by the new standards. They're just going to credit unearned rent. It's an unearned revenue account, which of course is a liability for them. So that's at the exception of the lease. Now we're again assuming a calendar year here for adjusting journal entry purposes. So on 12/31 of this year, X1, they're going to debit lease expense for the appropriate fraction, which is from 9/1 X1 to 12/31 X1, that's 4 months. So they're going to debit lease expense for 4/6 of that $3,000 amount. I'm sorry, 4/6. I wrote down 3/6. Which is $2,000. So they increase the liability on the interest portion over those 4 months. So the lease liability is going to be credited by its growth due to interest, which if we look at the amortization schedule, the first interest amount is in total for 6 months is $474. And we're going to take 4/6 of that. That's $316. And of course the difference, because this is US GAAP, is going to be the amortization of that ROU asset. So we don't record depreciation expense. It's impliedly in the lease expense number, but we're going to bring down the ROU asset. You don't use accumulated depreciation. You just bring it down directly. We could plug for this, or simply take what we got up here for depreciation, 2566, and take 4/6 of that. 25, 26, 4/6. That gives you 1,684. Okay. Now on the lessor side, if you think about what's going to happen for them, they're earning rent on this unearned rent of 3,000. So they would debit unearned rent. For 3,000 times 4/6, which is 2,000. And they have revenue. So what might seem odd, and this is the thing about this, there's an asymmetry in the accounting here. I suppose in an ideal world, when one party obtains an asset from another party, they'll put the ones that are obtaining the asset would put that asset on their books, but the one who's relinquishing the asset would take it off their books. And that's not done here. The lessor retains the asset on their books as well. And they're going to go ahead and depreciate that asset because they are the owner of that asset. So it seems a little odd. They're going to go ahead and record depreciation expense on the asset that's held by the lessee. Now, their carrying amount for this asset, the lessor's, has a cost to the lessor of $36,000 and an expected life of 5 years with zero residual. So that's what they're going to use to amortize or depreciate their asset. So 36,000, I'll just say 36K, no salvage value, just divide by its 5-year useful life. That would be a full year's depreciation, but we only need 4/12 of the year. So don't multiply that by 4/6, 4/12. So depreciation expense is $2,400. And they would have accumulated depreciation that's just the way I abbreviate it, of $2,400. Okay? So the next period or time that a journal entry would be made with respect to this is 3/1x2. That's the lease payment date. And so again, the lessee will record lease expense for the other 2/6 of the 3,000. Right? They had 4/6 accrued as of 12/31, but then another 2 months goes by, so now they have the other 2/6 of that, which is 1,000. They will reduce the lease liability, increase the liability by the interest. 474 as we used previously, but the other 2/6 of that. And that gives you 158. Sorry about that little interruption. I was trying to just check that the recording was working right because it wasn't showing on my screen. So we got to 3/1 of x2, and we have lease expense of 1,000. Lease liability is increased by 158. And as I said before, we're going to reduce the right of use asset. We could, again, prorate the 25, 26, but I also want to show you, you could just plug for this after you know the other numbers. And that's 842. And a payment is made on this date, so dollar for dollar, you reduce the lease liability for $3,000. Credit cash. Moving over to the lessor side, they adjust the unearned rent for the other 2/6 of 3,000. That's 1,000. And record the rent revenue. For that 1,000. And of course, they're also going to depreciate the asset since they own it. When I did this in class, I had a student ask me, well, would they really record depreciation expense on 3/1? That's a good question. The answer is, in practice, no. But for teaching purposes, I want you to know that this is going on underlying the time that's going by here. So that's why I'm recording depreciation expense at this point for the lessor. And in reality, I mean, if they're preparing quarterly financial statements, they would have to do it at 3/31. So what happens in reality and what you use for teaching purposes can sometimes be two different things, just to make sure that the concepts are brought out. So they would depreciate the asset. Accumulated depreciation is credited for $1,200, and that's the other 2/12 of that. They receive cash, of course, of 3,000. And that creates more what? Unearned rent, right? So that does it through 3/1 of X2. What I want to illustrate next is how IFRS, International Financial Reporting Standards, differ. That's what I ask on the next page here. It says, now prepare the lessee's journal entries through the same period under IFRS. And under IFRS, what I said is done is the lease expense amounts to the sum of the interest on the liability, but they use straight line depreciation on the right of use asset. So the depreciation amount we have to compute is they still have 16,545 as the present value, that is the lessee does. And there are going to be 6 periods of depreciation, that is six-month periods for the 3 years, and that gives you 2758. This is per 6 months depreciation. So the initial recording on 9/1 of X1 by the lessee, this is all for the lessee now, is the same as we did before. The right of use asset debited, liability for the lease is credited, for the 16,545. They make their payment immediately, so the lease liability is drawn down as I said, dollar for dollar. Excuse me. By 3,000. Credit cash. So on 12/31 of X1, the adjustments are as follows. So IFRS debits lease expense not for the lease payment, but we're actually going to plug for this under IFRS rules. How are we going to do that? Well, the interest on the liability increases the liability. We calculated that amount in the previous amortization schedule of $474 for the first 6-month period. So that interest, 4/6 of it is recorded at $316. And the ROU asset is amortized straight line. So we had calculated an amount for 6 months of $27.58. And that's a 6-month amount, so this is going to be 4/6 of that, which equals $18.38. And here's the plug. Clearly a plug for lease expense, $21.54. Okay, hope that makes sense, and that you see the difference between GAAP and IFRS. So 2 months later, 3/1/X2, they'll again plug for lease expense after computing the increase in the liability due to interest. $474 times 2/6, that's $158. And the ROU asset is amortized. They don't call it depreciation in the standard, it's called amortization. So that asset is, which is really the same thing, but that was $27.58. That's our 6-month amortization times 2/6, giving you $919. The plug, if you just add those up, you get 1,077. And as we did before, of course, we have a payment now, so that reduces the liability. Credit to cash. So that's how IFRS treats operating leases. And I want you to know the difference between US GAAP and IFRS on that point. So as I mentioned at the beginning of the chapter, there are really 2 types of leases. We just went over operating leases, but it's a lease that does not meet the capitalization criteria discussed in the next section. So now we're in the next section, and we have to talk about the capitalization criteria. Before I get into all the rules here, I want to just say that if you think about whether a lease is essentially the purchase of an asset, that's what you're answering by these criteria. So conceptually, it represents the purchase of an asset by the lessee from the lessor, and it's financed over time. An operating lease isn't like that because it's got a shorter period than the life of the asset by probably quite a bit. So the capitalization criteria which are largely the same as the old criteria under old GAAP. And this has just changed, so that's why I'm covering it in the summer school class. It has a couple of things in it that are different. And so let's read on. It says both the lessee and the lessor treat the transaction as a transfer of the asset under long-term financing. So unlike an operating lease where the lessor did not remove the asset from the books, now they're going to. It's just going to be treated like a sale. So if any of the following tests is met, the lease is a capital lease for both parties. If any one, so if you meet just one of these criteria, you've got a capital lease for both parties. The first is really a no-brainer. It's called the transfer of ownership test. And that's if the lease actually does transfer ownership of the underlying asset to the lessee at the end of the lease term or by the end of the lease term. There are tax reasons why the lessor wouldn't want to transfer ownership of its asset until the end of the lease, because they can get depreciation tax, other tax write-offs such as credits on their assets if they maintain ownership of it. So that's if you see that there's a transfer of ownership, that's the easiest one to look for, and you know it's a capital lease. The second is a purchase option test. I ask my students at this point, well, how often do you take advantage of bargains? And, we're all in search of bargains. So if you're already leasing the asset, you're the lessee, you're leasing the asset from the lessor, and the lessor has provided in the contract an agreement that you could purchase that asset at such a favorable price that you would be most certainly to do that, then it's called a bargain purchase option. So reading this, it says the lease grants the lessee an option to purchase the underlying asset that the lessee is reasonably certain to exercise. And the previous standard did call this a bargain purchase option. I probably will too. I'll probably continue to use that phrase because a bargain is a bargain. And you are presumed to take advantage of all bargains. So there are 5 of these criteria, and the third one is a lease term test. Conceptually, I just want to say that if the non-cancelable portion of a lease covers essentially the life of the asset, then you're essentially buying it. And that's what this is getting at. The concept is that the lease term is for the major part of the remaining economic life of the underlying asset. It says, however, if the commencement date falls at or near the end of the economic life of the asset, then this criterion is not used. The previous standard said, well, if the lease term is in the last 75 or greater percentage of the estimated economic life of the property, then this criterion wouldn't be used. And that's still the bright line guidance. The FASB, when they wrote the new standard, didn't have in it these percentages that we're going to talk about now. But they said in their interpretive guidance for it that the bright line percentages that were in the old standard could still be used. And so that's why I'm going to continue using them. The CPA exam will, and also in practice, I would say, we in the U.S. just like to know where's the line on this? What can I cross? And so forth. So we're going to use these bright line guidance percentages from the old standard as well. So the previous standard also stated that if the lease term falls in the last 25% of the economic life of the property, or if the leased property is land, which has no end to its economic life that we can know about, then that criterion does not apply. So these do remain the bright line guidance criteria. The fourth one, conceptually, I'd just like to say that if the present value of your lease payments essentially equals what you would pay to buy the asset outright, then it certainly smells like a capital lease. It just economically, it's going to have the same sort of principle of ownership, guaranteeing those rights and benefits of ownership. And it says this: the present value of the sum of the lease payments and any residual guaranteed by the lessee that is not already reflected in the lease payments equals or exceeds substantially all the fair value of the underlying asset. Now, just reading that aloud causes me to think, well, what, that's confusing. But now, if you think about that this way, that a lease, if it has a residual value at the termination of the lease term, the lessor could stipulate that it must be a certain value. So if you rent a car or lease a car for, say, 3 or 4 years, the lessor leasing company is going to say, well, we want the car returned at a value of this. And if you don't have a car that's of that value that you're returning, maybe you just use more wear and tear on it, then you would have to make up the difference in cash. And that's called a guaranteed residual value. The lease payments themselves might be provided by the lessor to include, what that value is, and that's what this sentence means. So the present value of the sum of the lease payments and any residual value guaranteed by the lessee that is not already reflected in the lease payments equals or exceeds what they say is substantially all of the fair value of the underlying asset. Well, what is substantially all of the fair value? The previous standard stipulated that the present value of the lease payments was greater than or equal to 90% of the fair value of the property. And again, that's still going to be the guidance that I'm going to use and what the CPA exam would use and what probably is going to be used in practice. So we're going to continue to use that as the bright line guidance. So if the present value of the lease payments and the residual value guaranteed by the lessee that is not reflected in those payments has a equal to 90 or more percentage of the fair value of the property, then that is that criterion met. And finally, there is a criterion they added to the old standard, which is an alternative use test. This is a good one. It says the underlying asset is of such a specialized nature that it is expected to have no alternative use to the lessor at the end of the lease term. So the previous standard didn't have that as a criterion, and it's a good one because sometimes some companies will manufacture assets that are really have only proprietary use to the lessee and no one else. Maybe the machinery that's used in the fabrication of their products is unique, doesn't have any resale value, so they manufacture that and lease it. The lessor would keep the depreciation deductions or the credits that they get on the asset for tax purposes. Excuse me, and yet that asset can't be sold at the termination of the lease. So that's the fifth one. And you look for any one of these 5, you got a capital lease. I apologize at the beginning about all the definitions, but we really have to go through these. They are GAAP. And so what are the lease payments? It says it's the sum of the following. And we've got what? 1, 2, 3, 4, 5 things that could be involved in the lease payments themselves. The first ones are straightforward. The fixed payments, these are the non-cancelable fixed payments required during the lease term. The second one under this is the variable payments. And these are included if the variable payments are determinable at the lease inception, if you can figure these out at the beginning of the lease. For example, some lease payments are scheduled just to increase by some percentage each year. You could also have them increase, say, by the inflation rate or whatever. Now, the lease payments that might be tied to an index, such as an inflation rate or CPI, Consumer Price Index, something like that, should be included at the level of the index on the commencement date. You don't know what that level is going to be later, so you just have to use the level at the commencement date, and thereafter, any inflation would have to be treated as an adjustment to the lease expense amount, but you can't discount that present value because you don't know it. And likewise, contingent amounts are not knowable at the commencement. I told you about royalty payments that might be paid to the lessor for store space in a mall, maybe. So those can't be included as part of the base rental payments because they're not known. So the second thing that is included that is different in the new standard is executory costs. What are executory costs? So at UVM, for example, the business school leases copiers, and included in the payments are amounts for maintaining the copiers. We certainly, as faculty, don't want to go around trying to learn how to fix copiers. So that's part of the lease. And so the lessor costs for things like maintenance here, they might have insurance needs to insure the property. That is, as owner, they continue to own the property and want to have insurance. They, as owner, might have to pay property taxes on their assets. In some local municipalities, that's the way it works, that businesses are actually taxed on the assets they own. So if these are included as a fixed component of the lease payments, then they are treated as part of the lessee's liability. And we'll talk about this further below after my initial example. The third one, as I said, if you have a bargain, you're going to take it. So lease payments would include an option to purchase the leased asset at such favorable terms that exercise by the lessee is reasonably certain to enact. And my wife always takes advantage of all bargains. And sometimes I talk to her, I say, we don't need that. Yeah, but it's such a great bargain. Now, anyway, so the standard is actually saying that if you have a bargain purchase option, you put that amount into the discounted value of the lease payments. The fourth is a guaranteed residual value deficiency. So, as I said, if you leased a car and you had to return that car at some value at the end of the lease, and you're guaranteeing that, and it doesn't hold up to that value, then you're going to have to pay cash. So this is if the lessee guarantees residual value, any amount it will probably owe to meet the guarantee beyond the simple return of the asset. Now, I find this one very strange in many cases, because here we have a guaranteed residual value, and the lessee would have to say, well, we're going to beat this asset up, and we're going to have an asset that's worth substantially less than the guaranteed residual value, and therefore we're going to estimate that we're probably going to have to pay some residual amount to make up the deficiency. The old standard just included the entire guaranteed residual value, so that when you return the asset, it settled the liability. The new standard, I don't know why exactly, but they did change it to this. It's just the amount that the lessee will probably owe in cash to make up a deficiency. Now, that would also have to be known by the lessor, as we're going to see. How would they know? So that's why I have a problem with this change and gap, but we'll live with it because we have to. So note that although all guaranteed residual value is used in the capitalization tests above, the lessee only includes this in its lease liability as if it's probable that it's going to have to pay it. So when I talked about up here, this present value test, it says the present value of the sum of the lease payments and any residual value guaranteed by the lessee, that is now already reflected in the lease payments. So that's the full guaranteed residual value up here, whereas it's only a deficiency down here. I hope that's clear. It should be clear if you really study it. Nice thing about summer school, again, is that you can listen to these videos over and over until you get to that point. So that can only happen if the expected residual value of the asset is less than its guaranteed residual value. Okay, I do have a footnote there for that. You could have a situation, and this gets a little bit more complex, where, okay, the lessee isn't going to guarantee the residual value, but the lessor puts in the lease payments an insurance amount that the lessor is paying to an insurance company to guarantee the residual value. So if you have a third party guaranteeing the residual value and they're not included in the lease payments, they are not going to be included in the lease payments unless included as executory costs borne by the lessee. So I'll say that again. The lessor wants to have this residual value. Maybe it contracts with a third-party insurance company or bank to guarantee that residual value. Well, therefore, the lessor is going to have to make payments for that insurance. Those payments are probably going to be included in the lease payments of the lessee, but they might not be. And if they're not, then they aren't part of the lease payments. It's also possible that the lessee pays a third party directly So if the lessee pays a third party directly to guarantee residual value rather than the lessor, then these payments are expensed as incurred and not treated as part of lease payments. So complexity in these definitions that I'll frankly tell you, when I was reading the standard, I had to really work through these things to write these notes. No textbook had these in them, and you just have to work through the standard itself to figure it out. And that was one of the troubling things for me, I'll just admit. Okay. So finally, failure to renew penalty. Sometimes leases will contain a clause that if you fail to renew, you have to pay a penalty for that. So that's going to be included in the lease payments. It says the amount of a penalty for failing to renew the lease at the expiration of the lease term. Now, if that penalty is so great, however, wouldn't the lessee continue to just go ahead and renew the policy, the lease? So it says, however, if the penalty is so large as to ensure renewal, then renewal is assumed and the lease payments would exclude that cost. Because they're not going to pay them, they're just going to lease the asset longer. You follow? So what is the lease term? It says it's the sum of the following, but not beyond the date of a bargain purchase option. So you got the fixed non-cancelable term. You got a period covered by a bargain renewal option. Again, a bargain is something that is likely to be exercised. And it says a bargain renewal option is a renewal option so advantageous in its terms that exercise by the lessee is reasonably certain. All right, well, that makes sense. So they're going to extend the lease term beyond the non-cancelable period for this renewal if it's a bargain. You could also have renewal periods that precede a bargain purchase option. They had to cover all their bases on this standard. So if you think about it, maybe you're leasing an airplane, a nice jet, like most airlines do. They lease them, and they lease them for 10 years, but then they stipulate that if you lease it for 15 years, we'll sell this jet aircraft to you for $10,000. I mean, that would be a bargain. And so that is going to mean that the 10-year lease term would be extended to 15 years because it precedes, that 5-year period would precede the bargain purchase option. Fourth, renewal periods preceding a significant failure to renew penalty. So any periods for which failure to renew a lease places such heavy penalties on the lessee that renewal is reasonably certain, like I said before, or any periods during which the lessor has the right to extend the lease. That would be rare where the lessor can say, I'm going to force you to lease this longer. But they put it in into gap just to cover their bases. So what I want to do is kind of just briefly talk about this. We're going to do the same thing for the lessee, but now the lessor is going to remove the asset from the books. I'm going to go right to a problem because you're probably hearing all this talk with just, it's like a waterfall over the ears. And so let's work a problem, start it anyway. It says, lessor company and lessee company signed a lease for heavy excavation equipment on January 1st of X1. So where this is at the beginning of the year. The lease contains the following provisions. The fixed non-cancelable lease term is 5 years and requires equal annual rental payments of $37,179, and this is at the beginning of the each year. I'm doing that for simplicity. I'm treating these as annual payments, but we still have an annuity due situation because they happen at the beginning of each year. Second, the lessor paid lessee a $3,000 rebate incentive to sign the lease contract. We'll talk about what happens with that. The lessee incurred $1,500 in attorney fees. I'm assuming these fees are paid to an attorney outside of the company, and to finalize and execute the lease contract. Fourth, the lease contains no renewal options, and the equipment reverts to the lessor at the termination of the lease. So there's no transfer of ownership at the end of the lease. That's the easiest one. If you saw that, you'd say, it's capital lease right away. The equipment is carried on the lessor's books at a cost of $150,000. It has a cash sales value of $160,000. Although the lessee fully guarantees a residual value of $8,000 at the end of the lease, here it is, It estimates that the probable value of the equipment at that time will only be $6,000. So the lessee is probably going to have to pay $2,000. That's what they estimate at the beginning of the lease term. The equipment has an expected economic life of 6 years. So this is a 5-year life, a 5-year lease, but a 6-year asset. And it says lessee has an incremental borrowing rate of 12% and is aware that the lease payments do not include any executory costs. That'll have implications in a moment. Lessor believes it is probable that all payments will be received, and that is just a stand-all always situation has to exist for contracts to be recorded as revenue. So what kind of lease is this to the lessee and to the lessor? We know it doesn't have a transfer of ownership based on what it says. So the very first criteria of the criteria is not met. Does it have a bargain purchase option? No, there's nothing in here about a purchase option. Third was the life test. Does it cover substantially all of the life of the asset? I'm trying to find where these are. Lease term. No, up here at capital lease. Right here. So the lease term is for a major part of the remaining economic life of the asset. We said that the 75% rule is going to be used still as our guidance. And so when you get to this problem, the third one is met. Why? Well, it says the lease term is 5 years. It's got a 6-year life. That amounts to 83%. Okay, which is greater than the 75% threshold in the bright line guidance. So therefore, since it meets one of these 5 criteria, it's going to be treated as a capital lease to both parties. Okay, so we hit number 3. We found yes, it meets that criterion. Therefore, it's a capital lease to both parties. All right, and if it didn't meet that criterion, we'd go on to the 4th and 5th and see if it met those. So what rate will the lessee use to compute the present value of the lease? What it says in the problem is the lessee has an incremental borrowing rate of 12%. Yeah, but it is aware that the lease payments do not include any executory costs. So what we said is the standard is that they use the implicit rate unless they don't know it. And my question is at this point, could they figure that out? If they know that the lease payments don't have any amounts in them other than for the recovery of the value of the asset itself, that is, they don't have any executory costs for things like insurance and maintenance and property taxes or the like, that the payments must be just solely a recovery of the value of the asset. Let's just see what the lessor thought of when they set the lease payments. That's a lessor on their side. Well, they'd say, well, the sales value of this asset is $160,000. I paid $150,000 for it. But the value that I could sell it for is $160,000, so I want to recover that in my lease payments. So the lessor, we know, calculated their lease payments to be $37,179, and that is purely just to recover the value of the asset, aside from the residual value. And we know that the lease payments are an annuity, so 1 minus. What rate did the lessor use? We'll call it I. There are 5 payments. So that's the ordinary factor. We know that we use an annuity due factor because of the first amount being paid initially at the beginning of the lease. And but that's not all. The lessor also has a guaranteed residual value of $8,000. You see, So they are going to get that back too. At least they surely think so. So the 160,000 is not just recovered through the lease payments themselves, but also the return of the asset that has a value of 8,000, but that's in 5 years. And so the question to you guys, could you figure out what I is? And the answer is yes. Now that you have a financial calculator, I couldn't do that algebraically, but I could do it with a financial calculator. Put your calculator in begin mode. You might want to stop the recording here to do two things. Use begin mode and clear the register, all the registers. That's the first thing you want to do. So the begin mode, remember, is to treat these as annuity due amounts. And just put in the parameters we know. We know, well, in any order, we could put these in, but this is what I have in order for the rows of the buttons on the calculator. 5N is N. I we don't know, so we skip that. Our present value, well, let's put in 160,000 negative in for present value. The other amounts have to be positive, so what's on one side of the equation is negative, and what's on the other side of the equation is positive. It doesn't matter what you do. We put in 37,179 as payment. That's a positive number. We put in 8,000 in for future value. Okay, and the beauty of the financial calculator is that now we can just go ahead and calculate I by hitting the I per year button, and you get 10. So you go ahead and do that, and you'll see that that's what you get. But be sure it's in the begin mode. For this chapter, leases are going to be annuity dues. And only some of the homework might say the payments occur at the end of the period, but that's not typical. So hopefully you all get 10%. So after solving this, the lessee would know the implicit rate in the lessee would be able to figure this out. And like I say, most lease contracts, vast majority would tell you the rate that the lessor is expecting to earn on the lease. But the lessee, in this case, from the information given, they could figure it out. Okay. So next we're asked, well, determine the lessee's liability on the inception date, 1/1 of X1. They would go ahead and figure out that present value. They know the lease payments, 37,179. They now know the discount rate that is implicit in the lease, 10%. Annuity due. But do they add 8,000 here? No. Only a residual value deficiency. So it has a guaranteed residual value of 8,000, but the probable value by the lessee is only 6,000. So the deficiency that they think that they have to pay probably is 2,000. Oops, 1 point. And what you get there, you could solve it on financial calculator, but hopefully what you get is 156,273. So on the next page, it says prepare the journal entries for lessee and lessor company on 1/1 of X1. On 1/1, Here's what the lessee does. I think you could almost guess. They're going to put on an asset, right of use asset, record a liability, for that 156. The number we just calculated was 156,273. Here's what the lessor does. Lease receivable. Well, how much? Is it the same amount? No, there's a little subtlety here. The lessee only put in $2,000 for the residual value that they're going to have to pay. But the lessor expects all of this to come back to them, all $8,000, because it's guaranteed. Even if it weren't guaranteed, they still have an expectation about a residual value. So what the lessor would record for their present value, of course, the lessor is using 10%. We know that now. But they would record the present value based on discounting the full 8,000 plus discounting these, but at 10%. And they would equal, that of course equals 160,000. So the lessor records a receivable of 160,000. They have sales revenue. $160,000. Presumably this asset is in their inventory, so they debit cost of goods sold. $150,000. And credit the inventory. It is possible, I'll just say parenthetically, it is possible it's on their books as just equipment if they're not really in the business of dealing in this stuff. That is $150,000. Now, the lease payment itself is a reduction of the lease liability by the lessee, $37,179, and they pay cash. But is that all the cash that's flowing at this date? No. Because we have a couple of other things. It says lessor paid lessee a $3,000 rebate incentive to sign the lease contract. Now what GAAP says about those sorts of things is they are an adjustment of the asset by the lessee. So the lessee is getting some, they're really paying less for this asset because of that rebate. I think you'd agree with that. So here it says, in this detail, incentives paid by the lessor to the lessee to enter onto a lease decrease the recorded cost of the ROU asset. The other thing that happened here in this problem was lessee had some initial direct costs. And what it says is this: for those, any costs that are incurred by the lessee to finalize or execute a lease, these increase the recorded cost of the ROU asset. We've got both going on in this problem. So if we get into the problem again, lessor paid lessee a $3,000 rebate, and lessee incurred $1,500 in attorney fees. Now these fees, these initial direct costs, have to be paid outside of the firm. If it's just normal stuff that the firm, if they had a department, for example, that deals in leases all the time, then no, not that. But any external costs that are paid by the lessee. So let's get back to those two cash amounts. The cash, by the way, that was received by the lessor, $37,179, is a direct reduction of their lease receivable. These could all be in one journal entry or a compound set of entries. I'm just breaking it out, hopefully in terms of the logic. But the other thing is, on the lessee side, well, they received cash of $3,000 from the lessor as a rebate. But they had to pay out $1,500 for the legal fees. So they're going to debit cash, a net debit of $1,500. And what's the credit then? Well, $3,000 of the rebate, I said, reduces the cost of the ROU asset to the lessee. But any initial direct costs that the lessee has to pay to execute the lease increase the value of that ROU asset. So the credit is a net reduction of $1,500 to that ROU asset. Okay? Hope that makes sense. I might, if I redo this problem someday, I might want to change the numbers here so that you don't get confused. It's exactly half. It just turns out to be half because they received $3,000, but they had to pay out $1,500, so the net in is $1,500. And both of these affect the ROU asset amounts, as I yellow highlighted up above. And the next thing I give you, and then we're going to close down for the day, says prepare the lessee's amortization schedule. Well, I've already done it for you. You'll notice that it ends up with a liability on the lessee's books of $2,000. That was the residual deficiency. But on the lessor side, since they capitalized $160,000, the full residual value shows up as a receivable on their side. Okay? So I'll stop it there and